Hello everyone, welcome back to CFA with J, where we crack CFA concepts the chill way. Today we'll be officially beginning our CFA Level 1 journey, and we are kicking it off with the first topic from the curriculum, that is portfolio management. We will be referring to Schwezer notes, and in this video I'll be explaining you important parts of the Schwezer notes. In this video, we are going to go through reading number 83, that is Portfolio Risk and Return Part 1. So let us begin. Give me a minute. I'll share my screen with you all so that it will be easier. Okay, so as you can see, we'll be starting with Portfolio Risk and Return Part 1. Module 83.1, Historical Risk and Return. In this, I want you guys to read this part. Pause the video, read it, and I'll explain it. Okay, so this paragraph says that evaluating investments using expected returns and variance of returns is a simplification because returns do not follow a normal distribution. Distributions are negatively skewed with greater kurtosis than normal distribution. So I'll show you guys this with drawings. So what does normal distribution mean? It means that this is the axis and your returns will be in this manner. This is what many models expect or just assume while giving you the result. But in reality, this is not the case. It says that the returns are negatively skewed and with a greater kurtosis. Now, negatively skewed means there is a chance that there will be bigger losses than gains. So I'll show you guys how negatively skewed graph actually looks like. So it looks like something like this. This has a very long tail on the left side and very big loss. This is how negatively skewed graph looks like. Further, we'll see how greater kurtosis looks like. Now, what does greater kurtosis mean? It means that you might see extreme results, even in the case of losses or in the case of gains. For example, the graph will be like this. It will be much taller. So it can go up, that is give you a lot of returns, or it can give you a lot of losses. So what this para tells us is that do not assume that returns will be in the form of normal distribution, but it will be in the form of negatively skewed and greater kurtosis type of returns. Then next important point is this, that is liquidity. This states that liquidity is an additional characteristic to consider when choosing investments because liquidity can affect price and therefore the expected returns of the security. So while considering which asset to invest in, liquidity is one of the major characteristics that you need to consider because it affects the price of the asset and the expected returns of the security. And liquidity can be a major concern for emerging markets that are new markets. For example, if there is a very backward country like any backward country and there is a new stock market in that which is emerging in that country. So liquidity is a very, very major concern because there will be many investors who might want to invest in it, but if the stock market or if the country doesn't go well, because it is basically at a developing stage or below that, if bad things happen, then there will be no buyer at the later point when you want to sell the shares that you have bought in that stock market. So liquidity, that is to convert cash, so that is to convert your assets into cash, will be very difficult in that market. And for the securities that are traded infrequently, such as low quality corporate bonds. Now, what are low quality corporate bonds? That they are the bonds that are issued by the companies which don't have much of the credit risk, credit rating. So liquidity will be an issue for such securities. Next, we'll be understanding what is a risk averse investor, a risk seeking, and a risk neutral. So I want you guys to pause the video for a second, take how much ever time you want, and read this entire part. This entire part. Okay. So I hope you guys took your time and read it. So a risk averse investor is a investor which technically doesn't like taking risk at all. He prefers less risky assets over more risky assets. If given two investments that have equal expected returns, a risk averse investor will choose the one with less risk. For example, if there is asset A and there is asset B, both give you, for example, 10% returns. But asset A is way less riskier than asset B. A risk averse investor will always choose asset number A. It says that financial models assume all investors are risk averse. Now, why do financial models assume all the investors are risk averse? Because if you imagine that in an economy, if everybody started loving risk, then market would become chaotic. The predictions would become very difficult. The forecasting will become very difficult. And for that reason, financial models assume that all investors are risk averse. Then next is a risk seeking, that is risk loving investor who prefers more risk to less. And given the expected returns, equal expected returns, would prefer the more risky investment. Let's take the same example. There is asset A and there is asset B. Asset A and B both are giving 10% returns. A is less riskier and B is way more riskier. A risk seeking or a risk loving investor would choose rather asset B than asset A. Now, what does risk neutral investor say? A risk neutral investor is an investor who is very neutral in his opinion based on risk. He would be very indifferent between two investments with equal expected returns. Now let's move to the next topic, that is this paragraph and this. I want you guys to read the above paragraph, pause the video, take your time and read it. I'll be explaining it to you after you read it. Okay, so investors utility function. Now, what is utility function? It simply means the satisfaction that an investor gets to through returns by taking on a certain amount of risk. What is an indifference curve? It is a tool in economics in this application. So it is basically a tool in economics, but in this figure 83.2, it is a which plots combination of risks and expected returns among which an investor is indifferent. So in figure 83.2, we show three indifference curves for an investor. The investor expected utility is same for all points, that is all portfolios along any single indifference curve. Portfolio along indifference curve 1, I1, are preferred to all portfolios along I2, which are preferred to all portfolios along I3. Now, why is this so? So now I want you to understand that this preference of an investor is entirely dependent upon two things, that is ER. Now, for new CFA learners, ER means expected returns, and this is standard deviation. This sign is standard deviation. This means risk, which includes total risk, that is systematic and unsystematic. We'll be learning about it in further readings, but just so that you know right now, I'm telling you. So now, why does an investor prefer I1 than I2 and then I3? Now, if you see, at this point, the person is taking risk, zero risk, correct? But still, he's getting higher returns than I2 or I3. For example, if this is 1, this is 2, and this is 3. The investor is getting more returns for taking the same amount of risk. So if you remember, I told you guys that risk averse investor usually prefers the less risky asset. If the returns are equal, here he is getting more returns for less amount of risk. So if you are, or if anyone is a risk averse investor, he would rather go for I1. And it is the same for all the points. For example, this is 1. For taking on 1 unit of risk, he's getting higher returns in I1 portfolio than in I2 and I3. Hence, technically, I1 portfolio which is on I1 curve is more preferred by any investor. Give me a minute. I want you guys to read this. Take a minute, pause the video, read it. I'll explain it then. Okay, so indifference curve slope upwards for risk-averse investors because they will take on more risk if they are compensated with greater expected returns. So if anyone is a risk-averse investor, they will take on more risk only and only if they are getting compensated with more returns. An investor who is more risk averse requires a greater increase in expected returns to compensate for the given increase in risk. If so, here they have just compared between a more risk averse investor and less risk averse investor. So greater the risk averse investor you are, the more the expected returns you'll be expecting on which would compensate your risk taking willingness. Next, in other words, the indifference curve of a more risk averse investor will be steeper than those of less risk averse investor, reflecting a higher risk aversion coefficient. It means that the indifference curve of a more risk averse person will be steeper. So if you see, it is steep. It is very difficult to climb. It is not like this. It is like this. This is more difficult to climb. So a risk averse investor will have an indifference curve that is more steeper. Moving forward, I want you guys to read this part. So, first of all, this formula is important. Now, I want you guys to understand one thing. For this figure, these curves were only that were about the portfolios that included only and only risky assets. Now we'll be talking about risk-free assets and we'll be including them in our curves. So this is expected return on portfolio. So how do we calculate expected return on portfolio? That is weight A. Weight A means weight of asset 1 plus expected returns of asset 1 plus weight of into expected returns of asset 1 plus weight of asset B, expected return of asset B. So we'll look at few of the sums related to this later and you'll understand its applications in later videos or maybe after some part of this video. But this, I want you guys to mark this formula. I also want you guys to mark this formula. Now, if you see, there is again this sign that is this. That is standard deviation of portfolio, means how risky the portfolio is. Now, to calculate this, you need weight of the asset, standard deviation of the asset, weight of another asset, standard deviation of another asset. And now this is correlation between the two assets. Now, how do we calculate it? Even that we'll be learning in further parts. But for now, I want you guys to mark this formula as important too. Now, this formula is used when there are both assets which are risky in nature. If there is a risk-free asset in your portfolio, it means now if you guys see this, it has standard deviation of asset B and standard deviation of asset A. What is standard deviation? It is risk. Now, for a risk-free asset, for example, a government bond, it does not have any risk. It is completely risk-free. That is what is assumed. It is backed by government. So, your standard deviation for that particular asset will be 0. So, this, now we'll suppose that asset A is a risky asset and asset B is a risk-free asset. So standard deviation for B will be 0. So this entire part, if multiplied by 0, will be 0, basic mathematics. And again here, even this part of the equation will be 0. So the only part remaining will be this. Because it is a risky asset, there will be standard deviation of that asset. Now it will be a certain number, for example, 24. So, standard deviation of a portfolio with only risky assets, the formula for that is this. Now, square root of square, squares get cut because of square root, basic mathematics again, and this is what you get. Even this is important. Now, combining a risky portfolio with a risk-free asset is the process that supports two-fund separation theorem. Now, what is two-fund separation theorem? Which it states that all investors' optimal portfolio will be made up of some combination of risk-free and risky assets. I will repeat again. Two-fund separation theorem states that an optimal portfolio of an investor will combine both a combination of both risky assets and risk-free assets. And the line representing these possible combinations is called as capital allocation line. Simple. A capital allocation line is a line which represents the optimal portfolio with a combination of risky and risk-free assets. So this figure 83.3, is given just for you to understand just so that it can help you guys to understand what capital allocation line means. So suppose this X is a portfolio. The more you go to the right of this portfolio on the CAL, the more risky your portfolio gets, and the more you go to this left side of the X, the less riskier your portfolio gets. Now, for new people, what is RF? RF is a point for the risk-free asset. So, starting from risk-free asset, the line moves forward based on the expected returns on portfolio and the standard deviation of the portfolio, or expected returns of the desired portfolio and expected standard deviation of the desired portfolio. That's it. Nothing more that this diagram tells us about. Let's move forward. So for this, if you can see, for a random investor A, X point, which is also there on capital allocation line and on indifference curve, is a optimal portfolio for that particular investor who seeks that much, a particular amount of standard deviation and a particular amount of return. That's it. Lower an investor's risk aversion, the flatter his indifference curve gets. So the lower an investor's risk aversion, want, or ability is, the flatter his curve gets, like this. There is there is a A and there is a B point. Now these two are different investors who want different risk and return combination. So they have just showed you guys how it would be plotted on indifference curve and on capital allocation line. Now, obviously, the person on who wants this portfolio wants more of risk and will be expecting more of return than that of this person. Let's move forward with this part, that is variance of returns for individual security. I want you guys to read that part and I'll explain it to you once you have read it. Okay. So in finance, variance and standard deviation of returns are common measures of investment risk. So these two are usually used to measure the risk of the portfolio or the investment. So this is the formula of variance. But if you guys remember, we have learned variance before in statistics too. So this version of the formula is given in just quite complicated way. To make it easier for you guys, formula of variance is summation of and portfolio X, return of portfolio X minus average or mean of return of portfolio X, square of that, summation of square of X minus X bar divided by N minus 1. So this is the simplified version of this formula. Or another simple thing that you can do is it is square of standard deviation. That's it. Okay. I hope you guys have noted down this formula and use it. I will be uploading a video showing you guys how to calculate standard deviation mean on uh, BA2 plus BA2 professional calculator, BA2 plus professional calculator. So you can watch that video. I will pin that video at the end of this video. Next is covariance and correlation of returns from two securities. I told you guys that we'll be learning about covariance and correlation of returns. Now, I want you guys to pause the video again, read this part of covariance, this entire part, and I'll explain it to you once you have read it. So, covariance measures the extent to which two variables move together over time. A positive covariance means that the variables tend to move together. Negative covariance means that two variables tend to move in opposite direction. Okay. So this is the formula for covariance on how to calculate covariance. Now, if you guys remember, we have learned about covariance and correlation before in our class 12th, maybe if you have taken maths or even in class 10th or 9th. So the answers of covariance, if you guys remember, vary from plus infinity to minus infinity. So how to predict or how to analyze the answer that we get by using this formula is that if it is a positive number, the two stocks will be moving in same direction. For example, if stock A moves up by 1%, stock B will also move up by 1%. If the covariance between stock A and stock B is positive, and if it is negative, it will go in opposite direction. If it is 0, the relation between them is not, well, means there is no relation between them. So yeah, that's it. Now, to tell you guys a simplified version formula of covariance. Covariance, if you guys remember, covariance, for example, covariance of asset A and B will take A, okay, X and Y only will take X, and Y is equal to summation of return of X, return on asset X minus mean of returns of asset A into returns on asset of Y minus mean on returns of assets of Y divided by n minus 1. So this is the basic formula of how to calculate covariance. Now, how to calculate covariance, even that can be calculated on your BA2 plus professional calculator, and I'll be teaching that in another video. If you want, I will pin those videos at the end of this video, and also I'll mention it in the comment section. Let's move forward. Now, as I had told you guys, this P means correlation between the two assets. So, how to predict or how to forecast or how to analyze a correlation between two assets? It is same as covariance. If one stock goes up, or if it is positive one. So, before we discuss that, I want you guys to know that correlation, answer of correlation varies from +1 to -1 only. It is not from plus infinity to minus infinity. It is from +1 to -1. So if the correlation is +1, means the movement of the both assets will be in same direction, either up or down. And if it is -1, it will be completely in opposite direction. Now, how to calculate correlation? Correlation formula is, there is no simplified version. This is only the formula. It is covariance of asset 1 and asset 2 divided by standard deviation of asset 1 and 2. Even this can be calculated very, very easily on your calculator, and I'll be teaching you guys this in further lectures. So, just read this thing. Read this. I'm not going to explain it because I have explained it already, and it is just in a very short manner. It is just extensive version of that. So I want you guys to read it. Next is calculate and interpret portfolio standard deviation. So how to calculate standard deviation of portfolio? This is the formula. We have learned this even before in this lecture. So just learn about it. What is standard deviation? It is the risk of the asset. Moving forward. Now, this is, I think, the last part of this reading, the efficient frontier. Let me check once. Yes. So, this is the last part of the reading, efficient frontier. Guys, whatever I am skipping in this video from these notes, I want you guys to at least go through it twice or thrice, because the total readings per subject, the total number of times you need to read a reading till you give your exam is at least 6 or 7 times, at least. Personally, that is my goal, and that is what I am following. And as we are learning together, I hope that even you guys follow that. And if I ever feel a need that there is more than there is any requirement that is more than that, I will come here and tell you guys about it. So I want you guys to read this part. I am not telling you, I am not going to teach you about this because you'll understand it after reading it. Then, okay. So this part is very important. I want you guys to pause the video, read this LOS 83.G, try to understand. I am here, I'm going to explain it. Pause the video, just read it, and then listen to my explanation. Okay, so the portfolios that have lowest standard deviation, portfolios that have lowest amount of risk of all the portfolios with a given expected return. Now, if there is a expected return given for many portfolios, and in that the least amount of risky portfolio is known as minimum variance portfolio, and and together they make many minimum variance portfolios make minimum variance frontier. Okay, simple. Next, I want you guys to understand this entire part. Okay, first we'll define efficient frontier. So, efficient frontier is a line that shows the best possible returns for every level of risk. For example, if there is certain amount of risk that is involved, the best return that you will get for that uh, amount of risk, the that is what the efficient frontier describes. The efficient frontier coincides with the top portion of minimum variance frontier. So so this just tells you guys that when there is minimum variance frontier and when there is efficient frontier, for example, if there is a minimum variance frontier like this and efficient frontier, efficient frontier is like this, at the top it coincides. That's it. Remember it just in case they give it for MCQ. Portfolios. So the portfolio on efficient frontier that has the least risk. So now if you see there is a point here, global minimum variance portfolio. Now on a efficient frontier, when the point which tells you that there is the least amount of risk by investing on in the portfolio that is on that point is called as global, that particular point is called as global minimum variance portfolio. Portfolio of efficient frontier with the least amount of risk is global minimum variance frontier. Now to explain you guys this figure 83.7, it is very simple. Expected returns and standard deviation. So this is efficient frontier line. Okay. Efficient frontier line. What is efficient frontier line? Recall it. It is a line that shows the best possible returns for every level of risk. Means for a certain level of risk, for a certain level of this is the best returns you will get. Best return you will get. So we know what is efficient frontier, what is global minimum variance portfolio. Now, what is inefficient portfolios? So now these small dots that you see, these are various portfolios that are not there, that are not on the efficient frontier. These give very less return for the same amount of risk which a portfolio is giving, which is on the efficient frontier. Hence, it is called as an inefficient portfolio. And individual security, as I said, that this is an individual security, and combining that is an inefficient portfolio. So that's it, guys. We are done with reading number 83 of our portfolio management. And stay tuned. Thank you for listening. I hope you have understood all of the concepts in this reading. I have tried to mostly cover all the important concept in this entire video for this entire reading. This is one of the major reading. The next reading number 84 is more lengthier, so we'll be doing it in two parts, and I'll be posting it soon enough. So stay tuned for that, and please hit the subscribe button if you want to continue the journey with me for CFA Level 1 exam. And thank you guys. Please read the reading once again and try to understand it. And I hope it helps you. Thank you. Bye bye. See you guys again in my next video. Please hit subscribe button and the bell icon. Thank you.